there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and I'm so glad you're joining me here on my weekly show on StockCharts TV. It's been such a pleasure here over the years to bring you some insights and perspective, all using the benefits and power of the StockCharts platform to do so. And I would say in this sort of environment with a lot of uncertainty, with a lot of instability, with plenty of reasons why the market could go dramatically higher or dramatically lower, I think now more than ever, it's important to watch the charts, to focus on trends. The point of being a trend follower, which is how I would primarily describe my general approach to investing, is to identify trends, follow those trends, and then anticipate when those trends are shifted. So to be clear, my number one goal is to find things that are working. And that's where I use the scan engine and other chartless tools on StockCharts. The number two item is to follow those trends, which means I want to continue to stay in things that are working and make sure that I get the maximum gain from participating in the bulk of the trend. That's how I use chartless to track positions that I own and make sure that I stay in winning trades. Then that third one, which is really the subject of today's video, is to anticipate when that trend may be shifted. So, we're going to talk about 4 charts that I'm going to be watching here on the StockCharts platform to navigate a potential market top as the S&P and the Nasdaq 100 test their 200-day moving averages from below. By the way, I'm going to be using the new market summary page on StockCharts. The market summary page has been around for a while, but it's had a complete overhaul in so many wonderful ways. And again, thanks to Grayson Rose and Chip Anderson and the team of developers at StockCharts for implementing a really nice upgrade to the market summary page. Selfishly, I would say I'm thankful that Grayson reached out to me and showed me an earlier version that I provided some feedback for, and almost everything we talked about was implemented in the final version. So it was continues to be a really great partnership, and one that I'm super thankful for. And job well done with this beautiful visualization. So I'll share with you, this market summary page is really designed to help you understand the market conditions by taking pieces, charts and data and putting it all in one sort of starting point. But I will tell you that this function, the market summary page, I don't think is designed to be the end, right? It's not designed to give you all the answers. It's designed more to help you think about what questions you should be asking, right? Which charts should I be looking at to get a better understanding of the current market environment and where things may be going next. So we start at the top just to sort of set the table for this meal we're going to have together. When you go to this first main table, this shows you the major U.S. equity indexes. Of course, we can switch to other things, but I'm going to sort the list by the stocks or the percent above the 200-day moving average. So I can see that only 2 of the indexes on this front page are currently above their 200-day moving average. The Dow Utilities Index is 2.2% above its 200-day. The New York Stock Exchange Composite Index, which is $NYA on StockCharts, is basically right at its 200-day moving average, and everything else is below. But some of these used to be a lot more below their 200-day moving average. The Nasdaq 100 is within 1% of its 200-day. The Russell 1000 Index is within 1% of its 200-day. Here's the S&P, which is only 1.3% below its 200-day moving average. So from early April to early May, we've seen a dramatic recovery, as I'm sure you know, of these major averages. The question, I don't think, is whether or not we've seen a significant rally off of the April lows. I think that's obviously undeniable. The real question, though, is sustainability, right? At some point, a V-shaped bottom like we saw on the S&P and the Nasdaq charts, at some point that becomes unsustainable because it doesn't just go to S&P 7000 from here. There are pullbacks along the way. And given the drop that we saw into early April, given the rally that we've seen into early May, we're right about at that point where it would be reasonable to expect things like the QQQ, the SPY, and others to find resistance because we're entering a resistance range. So, argument number one, I would say we're getting near that 200-day moving average. So what are the 4 charts that I'm going to be using? And again, all from this point. First off, I have to, of course, start with my own market trend model, which is thankfully featured toward the top of this page. And this is a model that I started using years ago and went through a number of different iterations over time, but settled into a series of weekly PPO indicators. So basically moving average based trend following indicators that define the market trend on 3 different time frames. I'll include a link in the description below or in the comments to a video where we talk about the market trend model in a little more detail, because I think that might be helpful for you if you're not familiar with it. But basically, these are the four main US ETFs that I'm tracking: the S&P large cap, S&P mid cap, Russell 2000 small cap, and the Nasdaq 100 more tech and communication names. 3 time frames. Short term for me is a couple weeks, medium term is a couple months, long term is a couple years. Totally generalizing there, but that's kind of how I would think of those different time frames. Now, if you look at what this model is telling you right now, is the short-term model is bullish on all of these different indexes, reflecting the strength that we saw off of the January low or the April low. And I'll show you the chart of this in a moment, by the way. The medium-term model still remains bearish, telling me that, you know, over that kind of couple months period, we've had a rally here in from early April to early May, but not enough to change the medium trend bullish just yet. I would argue a move above the 200 probably concludes that or completes that. And then finally, the long-term model, which as you can see is still bullish for the large caps and for the Nasdaq, but actually bearish now for mid caps and small caps. You can click on any of these. They're clickable links to get to the chart, but I'll show you the chart that I used to create this, and this is create this model. And then this is the chart that I still use every week with my Market Misbehavior Premium members as a way of demonstrating any changes in our investment outlook. So this is what the indicators look like, and these are the indicators that actually fuel that little cheat sheet that you saw on the market summary page. Here's the long-term model looking at the difference between some long-term weekly exponential moving averages, the 21 versus the 34. The medium term is the 5 versus the 13 week exponential moving averages, and then the short-term model is just where we're at versus the 5-week exponential moving average. And again, another video I'll post gets in a lot more detail. The short-term model for me turned bullish 2 Fridays ago. It had turned bearish in mid-February after the February market peak, had remained bearish up until 2 Fridays ago, not last week, but the week before, when it finally turned back positive. Here's a medium-term model getting very close to the zero level, but still remaining bearish, basically saying that this is still the medium-term trend, according to my model, making a pattern of lower highs and lower lows. The long-term model, if I had a neutral setting, it would be neutral because we're almost exactly at zero, but it's technically still bullish for the last couple weeks after almost turning negative. And that strength of the rally in April really prevented that indicator from going very clearly bearish here. So my model is still saying the long-term trend is still good. The medium-term trend is weak. The short-term trend is positive. That is the setup. That is where we're at going into this test of the 200-day moving average. And as I look at, I think the next one we'll look at the stocks S&P versus the 200-day moving average. But you know, I would say for now, the reason why you watch this chart is to see if the short-term model turns back negative, if the medium-term model remains bearish. If those two things happen, that would most likely confirm a short-term peak. Unable to break above the 200-day, probably seeing a downside move going into further into the month of May. So this market trend model for me, it's not predictive, right? It's not telling me what I think is going to happen over the next month. It's just defining what has happened on these time frames. And for me, it is a great objective, not subjective, but objective, systematic way of defining the trend. And the medium-term model remaining weak is the main reason why I think it's important to watch this chart right about now. So you can use that market models widget to follow the timeframes. Also, look at the macro model, which is we're looking at stocks, bonds, commodities, and the US dollar. All those other three are bearish on all 3 timeframes right about now. The only one with any sort of bullish activity is stocks. So it tells me remaining stocks over other asset classes for now, at least on the short term, is the right tactical trend. But all of them bearish on the medium term, and that's probably one of the more concerning features of the market trend model right about now. The second chart I will be watching is down here in the lower left. We can see breadth, right? So we can see right now this is stocks advancing and declining, and I refer to this often on my market recap show called Chart This with Dave Keller. But if I click on the moving average tab, this is a beautiful sort of heat map style visualization showing you the major US equity indexes and what percent of the members of those indexes are above their 20-day moving average, 50-day, 100-day, and 200-day moving averages. If you brought this up about a month ago in early April, all of these were pretty much red, right? Because everything had gone below their 200-day and 100-day and 50-day, and most things were below their 20-day as well. So all of this was red. You initially have that bounce off of the early April low, and all of a sudden, this starts to turn higher, right? All of a sudden, you have about 85% of the S&P 500 members above their 20-day moving average. Almost 90% of the Nasdaq 100 names above their 20-day moving average. That's how broad this bounce off of the early April lows has been. The percent of stocks above their 50-day now neutral, right? It's not especially high. You're not seeing them color-coded in green, but they're definitely no longer red anymore. They're more in that neutral amber color, which tells you that a lot of stocks have regained their 50-day moving average, but not everything. But here's the real concerning part, right? Most things remain below their 100-day moving average, and most stocks in any of these buckets remain below their 200-day moving average. Here's the chart that I use to look at a little more detail on that particular analysis. This is the S&P 500 on a closing basis, going back for the last 2 years. Here's the percent of S&P stocks above their 200-day moving average, and here's the percent of S&P stocks above their 50-day moving average. We can see that at the April market low, this was down less than 10%. Now it's up to around 56%. So literally about half of the S&P were below their moving average in early April and are now above their 50-day moving average here in early May. That is a dramatic turnaround for sure. And the fact that it's above 50% is pretty meaningful. And I will tell you, one of the things I would look for to tell me, okay, this short-term tactical rally is now exhausted, would be this indicator getting back below 50%. Look what happened back here in January of 2025. We went up above 50%. We remained there for about 6 weeks as the S&P made a new all-time high into the February peak above 6,100. From there, we broke below 50%, and that was a sign that the tactical breath was now weak, and that sort of opened the door to the waterfall decline that went into that early April low. So as long as this holds 50%, things are pretty good. If it breaks 50%, that will be bad. The other item I would look at, and this was that last column on the market summary widget, was looking at the percent of stocks above their 200-day. It's still less than half of the S&P. It's currently around 43%. If and when that would get above 50%, that all of a sudden starts to look like a broad recovery because the 200-day moving average is a big deal, right? The S&P is rallying up to the 200-day, currently around 5750. We see that as the beginning of what we call a resistance range from 5750 to 5800. I'd need to see the S&P clear 5800, which would clear the late March high, would also clear the 200-day moving average. Unless that happens, I think this trend still remains more bearish than bullish. So what we're looking for here is this to stall out below 50% or just be unable to hold a 50% level, and for the percent of stocks above their 50-day moving average to break back below 50%. That's why this chart could be so vital. It's been a broad tactical advance off the early April low. Any tactical weakness will be reflected on that chart. That's why I'm watching that chart and also watching this widget on the market summary page. Third item I'm looking at are called the Bullish Percent Indexes. This is a series of breadth indicators based on point and figure charts. Asks a simple question. Out of this universe of stocks, whichever row we look at, what percent of them have most recently given a buy signal on their point and figure chart? Now, overall, it's pretty strong. 71% of the S&P 500 members have given a buy signal on their point and figure chart. Almost 80% of the Nasdaq 100 members a buy signal on their point and figure chart. The New York Stock Exchange, less encouraging, but still above 50%, but still not near the extreme levels that we've seen. So this is definitely telling you it's large caps over small caps continuing to dominate investors' thinking. Here are two charts that I would use as a way to supplement what we just saw on the market summary page. And again, you can click on here to see sort of demo versions of these charts. These are the ones that I use in my own chart list to answer these questions. Here's the S&P 500's Bullish Percent Index. You can see we went from almost 10% in early April to now just above 70%. So again, most of the S&P saw a buy signal from their point and figure charts in the month of April. That's a dramatic improvement and a pretty good buy signal. But here's the problem. We're now above 70%. The Nasdaq 100's Bullish Percent Index, also above 70%. I have horizontal lines around the 70% level because that's the level where I start to feel like we might be pretty overextended here. What I found is when the indicators go above 70% and then back below that 70% range, you can see it often lines up with some tactical peaks, right? Some levels where we get at least some sort of pullback. In some cases, get a much more significant decline. So the fact that we're above 70% tells you there's been a broad advance off of the lows, but at some point, breadth indicators like this start to look almost too good. They look too strong, as if almost everything started to rally. And while that may lead to long-term strength later this year, it usually suggests that stocks are leaning a little too far over their skis and probably have to lighten up a little bit. So the fact that we're seeing these overbought conditions as the S&P and the Nasdaq are testing this key resistance zone starts to line up a narrative in my mind, or at least a confluence of evidence suggesting we've had a significant rally, but the breadth indicators are too strong. We've had a meaningful bounce off of the lows, but now we're heading to the ultimate long-term barometer, the 200-day moving average, and I'm not sure that there's enough momentum left to push above those levels. So these are the, third piece of evidence that I'll be looking at are the bullish percent indexes and watching to see if and when they rotate back below 70%. You can monitor that just from the market summary page. They're currently green above 70%. Look if they start to dip below 70%. The fourth thing that I'm looking at on this market summary page to navigate this current environment is a section called key ratios. Now, there are a bunch of different ratios that are included here. Ratio analysis is basically a play on relative strength investing, which is basically comparing two different things, either a stock or ETF versus its benchmark, or stocks relative to one another, and just looking at a ratio. So when the ratio is going up, that means the one is outperforming the other, and when it rotates back down, that means it flips, and the other one is outperforming the first one. So ratio analysis is a very effective way of comparing and contrasting two different stocks, two different sectors, two different themes, two different markets, and seeing how they're performing relative to one another. If you want more information on relative strength investing, by the way, I just interviewed John Roque of 22V Research on my podcast last week. We talked a lot about relative strength. My favorite analogy about relative strength, which is all about baseball, I got from John Roque in a meeting that he provided years ago in my Fidelity days. I'll include a link to that podcast interview as well, because you should check that out. He's a smart guy with an incredible career in the financial industry. Big fan of relative strength. And after you hear his discussion, I think you'll see why it's so meaningful. These ratios are just key ratios that help you determine whether offense or defense is doing better. And what I mean is consumer discretionary versus consumer staples. You have things you want versus things you need. The idea here is consumer discretionary are not things you absolutely need. They're things you want. It's like a new watch, new clothes, travel, tourism, nice hotels. Those are all things it's nice to do when you have the money to spend on it. But if not, it's not the end of the world. Staples are things you need. One of my mentors, I would say, Alan Shaw, famously said, he was the technical analyst at Smith Barney for a number of years. He said, when the going gets tough, the tough get eating, drinking, and smoking. And so staples are things like grocery stores, tobacco, beverages, alcohol, home products, and things like that. You don't tend to change those habits and those needs based on economic conditions, right? If money's tight, you're still buying toilet paper and cleaning products and things like that. And so the idea is staples are relatively stable. Discretionary is more volatile or more sensitive to economic changes. So if this ratio is going up, that means offense is outperforming defense. Investors are optimistic. If defense is outperforming offense, this ratio is going down. Investors are less optimistic about the growth in economic conditions. Same thing with technologies, more of a growth-oriented leadership sector versus utilities, more of a low volatility defensive sector. Biotech is more of the offensive side of the healthcare sector versus like pharmaceuticals and healthcare providers. So biotech versus healthcare, hotels versus utilities. All of these different ratios are key measures of offense versus defense. Now, you can click on any one of those to get a chart, and I'd encourage you to save it to your own login. You should do that, but this is the ratio chart that I use to analyze offense over defense. Here's the cap-weighted version, and you saw in that widget there's an equal-weighted version as well, and I like to look at both of them together, but you can look at them independently as well. And basically, when this ratio is going up, like we saw from August of last year through January, February of 2025, that means offense is outperforming defense. That means conditions are good. When the ratios are going lower, like they did from January, February to mid-April, that tells you conditions are not good, or at least investors are anticipating weaker conditions. Look at what's happened from mid-April to now early May, the ratio starting to turn higher. I think these offense to defense ratios are crucial at this particular moment because they were very negative for the first quarter. Going into April, they were remarkably negative going into the April low. As the S&P and Nasdaq bounced off of their early April lows, these ratios have both rotated higher from mid-April to early May. If those ratios can continue to go higher, that should give you more confidence that the S&P and the Nasdaq can power through their 200-day moving average and get even more gains beyond that. If, however, these ratios start to turn lower, that would suggest that investors that were buying into short-term strength are now recognizing longer-term conditions may not be as optimistic. They start to rotate to more defensive positioning. These ratios go lower. That would be a big red flag for the financial markets. And I would say with any of these, that's a pretty meaningful thing to do. You can click through any of the charts. You can see the quick ratio chart. Again, technology versus utilities has rotated higher for now, bouncing off of that early April low. Keep an eye on the ratios like this, though. And again, any rotation lower could be an interesting data point telling us institutional investors who drive the majority of these flows are maybe getting a little more defensive. So that's it. Those are 4 key ratios, 4 key data points, that I'm watching, all part of the market summary page. And again, as I hope I demonstrate, I think the market summary page, this new updated version on StockCharts, isn't the end, right? This isn't the only thing I would have. This is the kind of thing I would have up on another monitor, on another screen, but then drill into it all the time. Use this as a starting point, as the menu, and then you start picking your courses out and dig a little deeper on here. Charts that you find really interesting, some of these charts that maybe you'd not seen before, save those to a chart list that you review regularly. That's how I eventually made what I call my Market Misbehavior Live chart list, which is a set of charts I review every single morning. It started from doing this sort of iterative process of, finding things that were interesting, saving them to a list. Eventually I had a pretty good list of charts that I wanted to refer to all the time. So hopefully this helps you understand that feature of the StockCharts platform. Hopefully it empowers you to use it to navigate these markets. And overall, I would say the rally off the early April lows has been impressive on the tactical time frame. I'm concerned about the sustainability on the medium-term time frame. The 200-day is crucial. These 4 areas of the market that we highlight today, those are the charts that I will be watching to determine whether a breakout is happening and whether that should be trusted. That's it for now. Thanks so much for watching my weekly show on StockCharts TV. Don't forget, I host a market recap show every weekday after the close called Chart This with Dave Keller. That's on my YouTube channel called Market Misbehavior. That's it for today. Thanks so much for watching. And remember, it's always a good time to own good charts. Take care, folks.